BlackBerry closed at $5.94 on Monday, its highest price in over a year, while every major Wall Street analyst covering the stock had a price target below what it was already trading at. The average target, $4.88. The stock blew past that by more than 20%. On the same day, the broader TSX was under pressure, with Canadian and U.S. markets falling amid surging oil prices and geopolitical uncertainty tied to the war in Iran. That's the context BlackBerry chose to stage a breakout in.
BlackBerry's rally was triggered by a Wall Street Journal report highlighting renewed momentum in its QNX division, the embedded software unit that develops operating systems for driver assistance systems, vehicle networking, and safety-critical applications. QNX is not new. It has been quietly running inside automobiles for years. But the WSJ piece crystallized something that the market had been slowly repricing. QNX is now deployed in more than 275 million vehicles worldwide. In fiscal 2026, the segment generated $268 million in revenue, nearly half of BlackBerry's total. In Q4 alone, QNX brought in $65.8 million, supported by licensing and royalty growth that compounds as vehicle shipments accumulate royalty-bearing units. The mechanism is unusual in software. Most SaaS businesses charge a recurring subscription. QNX charges a royalty per vehicle unit shipped. That means revenue scales with the automotive industry's output, not with BlackBerry's sales cycle. As global automakers have ramped production through 2025 and into 2026, even amid tariff disruptions, each unit carries a QNX royalty attached to it. The company doesn't need to win new contracts to grow that line. It just needs cars to ship. What makes Monday's move harder to explain through simple momentum is where QNX is expanding. The WSJ report noted growing adoption beyond automotive, medical devices, industrial systems, aerospace. These are exactly the sectors where regulatory requirements mandate a certified real-time operating system. QNX holds a safety certification moat that competitors have spent years trying to replicate. That certification takes years to earn, and even longer to renegotiate out of production systems once embedded. Here is where the picture complicates. BlackBerry carries a PEG ratio of 0.06, extraordinarily low, suggesting the market is pricing in near zero long-term growth relative to current earnings. That's the bear case in one number. The bulls trading at 6.07 are betting that royalty-bearing automotive software in 275 million vehicles, expanding into medical and industrial, with an irreplaceable safety cert moat is worth considerably more than $4.88 a share. Both cannot be right. And it is worth noting that BlackBerry's CEO sold 27,066 shares at $3.56 in early April, just 4 weeks before the stock crossed $6.
The last time BlackBerry captured the market's imagination was different. In early 2021, the meme stock surge pushed the stock above $25 before it collapsed. That episode was driven by retail short squeeze mechanics, with no connection to operating fundamentals. Monday's move looks structurally different. It was triggered by a reported business development in a specific division, backed by disclosed revenue figures. The 51% year-to-date gain BlackBerry has accumulated in 2026 has been building gradually, not in a single spike. That cadence matters when distinguishing a fundamental re-rating from a narrative-driven overshoot. The historical parallel worth watching is Qualcomm in the late 2010s, a company deeply embedded in device infrastructure, with a royalty per unit model, broad reach, and persistent undervaluation, repeatedly frustrated analysts who rated it a hold while the royalty base kept compounding. Qualcomm's eventual re-rating came when automotive and IoT royalties became visible enough to force model revisions across the street. BlackBerry is not Qualcomm in scale, but the structural logic, embedded IP royalties that expand without new sales cycles, follows the same pattern. The conditions that would sustain the current trajectory, global auto production holding above 85 million units annually, which maintains QNX's royalty days, continued expansion into medical and industrial verticals that carry higher margin, longer lifecycle contracts, and no material disruption to BlackBerry's Cylance cybersecurity unit, which remains the drag on overall profitability. The verification benchmark to watch by this Friday is the volume trend. Monday's 3.57 million shares traded, 42% above average daily volume, needs institutional follow-through to signal conviction, rather than a single-session reaction to the WSJ piece. The breakdown scenario is also concrete. BlackBerry carries $268 million in long-term debt and a debt-to-equity ratio of 2.52. If interest rates stay elevated through the second half of 2026, a real possibility given the Bank of Canada's stated uncertainty, refinancing pressure could erode the margin of safety that QNX's royalty growth is currently providing. The stock could retrace to the $4.50 to $4.88 analyst consensus range without any change in the underlying automotive business, simply on rate-driven multiple compression. Evidence so far tilts toward a genuine re-rating of QNX rather than noise. The revenue is disclosed, the vehicle count is auditable, and the safety certification mode is verifiable. But the ceiling holds only while auto production remains robust and rates don't bite the balance sheet harder than royalties can offset. The one question this breakout leaves open, if QNX is worth this much now, why did BlackBerry's own CEO sell at $356 4 weeks ago? Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.